energy markets have not been living up to their name. They have been less than energetic. In fact, they've been sluggish. Between trade skirmishes on multiple fronts, moderately softening economic data, and oversupply issues, the energy markets such as crude oil and natural gas have been pushed back on their heels. Also, despite a sharp recovery in the stock market, both energy markets have failed to follow suit. However, we think that eventually will change. That said, the ride's going to be bumpy. Today our focus is going to be on the natural gas futures market. Natural gas has been a trader's market. For anybody looking to buy and hold, this is not the place for you. Buy and hold investors will probably have a really hard time making money in natural gas. If you look at a chart over the last couple of years, we've seen natural gas fall into the low $2 area and quickly jump up into the $4 and in one particular case almost $5 range, but the rallies haven't been able to hold. Rallies have been short-lived and they fizzled back down, pushing prices into the low $2, which is what we're starting to see now. We've noticed that the number of speculators betting on the short side of natural gas, in other words, looking for natural gas prices to go lower, is growing. In fact, it's becoming a little concerning. We are starting to get into the range where we believe the trade could be getting overcrowded. For instance, according to the CFTC, the Commodity Futures Trading Commission, they release a weekly report called the COT report, or the Commitment of Traders report, which tells us where traders are positioned and to which magnitude. At the moment, large speculators, which are considered to be the smart money because they tend to have deep pockets and are holding big positions, they're holding a net short position of about 104,000 contracts. To put this into perspective, the last rally started once the net short position grew to about 130,000 contracts. So while we may have a little room to move on the downside, and we're not seeing necessarily record net short positions, it's just something to keep an eye on. The idea is, if everybody's short, the market tends to run out of sellers, and that sometimes can trigger a short covering bounce or maybe even a short squeeze, which is what we've seen over the last couple of years. Those runs to $4 have been mostly on short covering. The fundamental backdrop for natural gas includes some gaping holds. For instance, the exportation of liquid natural gas out of the U.S. is probably going to be a game changer at some point, but there's quite a few wrinkles in the short run that need to be ironed out. Further, there's a supply glut, which is forcing a lot of producers to sell product well below cost, and this is pushing the market towards multi-year lows. Nevertheless, a weekly chart of gas depicts a market that's trolling support levels in search of some sort of low. In our opinion, swing traders should be eyeing the area between 230 and 190-ish, 193, as a zone to initiate bullish positions. Obviously, this is a relatively big range, so the way we would look at it is the 230s are considered a nibble area, and if we do happen to get down below $2 into the 190, 193 area, it might be a place to get a little more aggressive. Keep in mind, in late 2015, early 2016, natural gas prices did see the 160s, 170s, but that was mostly with the front month contract and probably a bit of an anomaly. It didn't stay there long. That said, anybody that wants to play in natural gas, which is a market that's deemed the widowmaker for good reason, should account for that possibility. So leave yourself plenty of room for error.